I'm Brian Love. I'll be moderating here with Paul Davis again. The genesis of this panel, to me, and I'm an aficionado of M&A. I've been putting it out on LinkedIn. Every time I see it, I try and break the news. Is to get different perspectives on M&A. We have the investment banker, the financial advisor, the legal advisor, and then we have someone who's actually at a bank that just executed a piece of M&A. So that's the genesis of this conversation, and we're going to pick their brains and let them introduce themselves. Frank, if you want to get started.
Frank Sorrentino, Stevens Inc. I'll keep the intro short, but former KBW guy and been doing this for 15 years. I spend most of my time in the Mid-Atlantic region and kind of have some clients elsewhere, Midwest and Southeast. And I actually had the pleasure of working, we're working on a couple deals together, and Jake and I worked together at KBW, and we advised them on their most recent acquisition.
Jeff Cardone, great to be here. Partner at Luse, Gorman. Been with the firm about 20 years. I primarily focus on bank M&A. I've been doing a lot. I know this is a dirty topic, but credit union bank deals as well. So I'm sure we'll talk a little bit about that. But again, pleasure to be here with this esteemed panel.
Jake Dalaya. I'm Chief Strategy Officer at Capital Bank. And prior to joining Capital, I was an investment banker for several years at KBW and JP Morgan.
And Paul, you write a lot about M&A, so you're also an M&A aficionado.
Yeah, I mean, it goes back to when I was at American Banker. Not only did I oversee the community banking coverage, but because that's where the majority of deals were being done, I was also in charge of M&A there as well. So yeah, it's interesting to see the ebb and flow of deal making over the past decade and a half, especially since the financial crisis of 2007, 2008. Yeah.
My first question is about merger of equals. You're seeing a few of these happen, and I just wanted to get your overall take on, is this a trend that will be continuing in your perspective? Frank, if you want to get us started.
I'd be happy to start. Yeah, I mean, I think you've seen a lot of them, and you're going to continue to see them. You're seeing them because there's a lack of capable outright acquirers, and so I think we're in I'd say in most geographies and most asset size classes right now, you have a situation where there's probably more sellers than there are acquirers. And so when that happens, you tend to see more of the MOE deals because that's the only deal that's really out there. Or you see more credit union, and particularly on the smaller bank side. The MOEs are really tough, though. I mean, first of all, we're in a closed room, right? There is no such thing as an MOE. Right. Somebody has to win. I don't care what anybody tells you. Somebody has to be a quarterback, right? You can't have two quarterbacks. There's one quarterback. They're very, very hard transactions. There's been a slew of them. If you think back, even like larger banks, right? Starting kind of with SunTrust, Truist, Chemical, TCF, that sort of kicked off a whole number of these, really starting in that 2018 area. You can look at what the combined company, in terms of what actually happened versus what they told people with financials and share price. I would tell you that roughly 2/3 of the deals do not work. And although the ones that do work very, very well. And there's certain characteristics to it, and we can certainly talk about that. But I mean, I think Truist, I apologize for saying this, but Truist is going to go down as probably the worst MOE that's ever been done. I mean, even with the sale of their insurance business, which was, by the way, an absolute gem, the stock has underperformed meaningfully. And so they're really, really hard deals. But yeah, we are going to see more of them. And I would just maybe last point on this, I think kind of counterintuitive, the ones that have worked really, really well, just whether economically or just from a shareholder performance standpoint, tend to be complementary, meaning not a lot of overlap within branch network, whether maybe even like business lines. You get less cost synergies, but these deals really work when you get the ultimately revenue synergies and cultures work. And if there's too much cost savings and too much people take out, everybody models cost saves. Nobody models revenue coming off. So, all right, I'm done on my MOE tirade.
Well, the only thing I would add, I think you nailed it about they're hard deals. You got to make the social aspects of the deal work, composition of management team, composition of board. But I would caution management teams, this happens a lot, where in theory you want to look and do MOE deals, you go to your board, and then your board pivots and says, well, why are we looking at a low premium deal? Why don't we look at other buyers and do a full exit from the market too? So we do, even though we talk MOEs a lot with our clients, it does sort of lead to that next step, and why do the MOE route and go through all this heartache when we can just sell and get a better price for our shareholders?
Yeah, I mean, Frank, you said it well. I think MOEs are here to stay. I think people appreciate that more than ever. Scale is the foundation for profitability in our industry. Having been through, I forgot to say in my intro that I did work at Webster and Sterling, 2 different stints. And so having been through multiple transformative mergers, they're incredibly difficult to execute, which is why you do price it, from a corporate finance perspective at a low premium, because there's less of a premium. There's more coverage on your synergies in terms of what you're giving away. So I think MOEs are here to stay.
The last real point, you got to make the compensation work. That's critical for these deals, particularly if one C-suite group has SERPs, employment agreements, change of control agreement, equity plans. The other team does not. Trying to integrate that and migrate that together is very important. It's a key element to those deals. You'd be surprised.
I'd love to just kind of zoom out just a little bit, right? Because we did have a slowdown in activity last year. We're starting to see some pickups, not just MOEs, but just in general, especially some larger deals. We'll talk about the ones that have capital raises involved later. But curious, what were you guys saw, what were the biggest impediments last year, and are those impediments starting to dissipate, and where do you guys see things going forward? Kind of where are we right now in the state of activity?
Well, I'll start. I would say economically things are looking better than where they were. I think that's why you're seeing these large deals. I would say though there's still a lot of, obviously we have a political election, a very divided country, kind of enough said there. But I think the other thing is, which has not been solved, is the regulatory aspect and getting regulatory approvals. I mean, that's been a real bear. And if you read the policy statements put out by the OCC and the FDIC on mergers, I mean, what my big takeaway from that was the true emphasis on the consumer and the impact of these transactions on the consumer. And so we spent a lot of time in the application process, whether it's bank-to-bank deals, credit union bank deals, mapping out the products and services from the buyers and the sellers, how that's going to transition, branch closures. I mean, the FDIC in particular has just been very deliberate on that, and it's really slowed down the process, in my opinion, with that. But that's something you have to kind of go in with a plan, and really want to be proactive as part of the application process, just to kind of expedite getting approvals.
Yeah, and I'll push on that a little bit. I think I think part of the reason why you're seeing more deal flow, particularly in the last couple of months, is banks. We are in Atlantic City, putting their chips in and trying to get deals in the pipeline for regulatory approval as a hedge against an administration that might be a little bit more skeptical on M&A. So if there is for instance, a Kamala win in November, by that point the applications would be seasoned. So I do think that's driving some of the recent volume. Just conjecture from my end. You mentioned larger deal sizes. I think part of that is, and Frank can keep me honest here, and it'd be interesting to look at some of the S4s, but I suspect that some of these deals were coming to fruition in the earlier part of the year when banks were more near technical lows, and now you're seeing a bit on the sector, and some of the deal values are creeping up. So just a guess there as to why you're seeing the increase.
So one other thing before Frank can jump in on I'll just say on the regulatory front, that's very frustrating. Even smaller deals, I'd say the regulatory process goes to Washington, D.C. to die. So when it starts out in the regional offices, when it kicks to and it just sits and waiting, and it's frustratingly slow. So hopefully that will ease up, but at least on the economic side, things are looking better.
Yeah, I mean, I think about the last 2 years has been pretty slow. Why? The two probably biggest impediments, and it's kind of a chicken and egg, but the interest rate, like mark to market, has made the economics very challenging, coupled with share prices. Bank stocks have been all over the place, but mostly below average, below kind of long-term averages. And really, you've only seen in the last, 60 days, prices come off of lows and are more, in some cases, more aligned with kind of long-term averages. The one thing we've noticed, and this is not like a huge sample size, but felt like a lot of deal activity to Jake's point, I feel like started to really heat up, or at least early conversations heated up back in January, February, and these things take a long time. But I think it was all coming from the same place, which was, I think a lot of management teams were looking at just earnings forecasts for the next year or two out, and even under a very I guess bullish interest rate cut scenario, which at the time that's kind of what the consensus curve had, the earnings forecast did not look good. And look, let's face it, we're in a industry where CEO age it tends to be in the 60-year-old camp, and a lot of companies I think sit in a position where they don't have succession, and they're probably thinking about exiting in the next 3 to 5 years, and earnings don't look good today. And then you kind of couple it with what I had said earlier, which was there's not a lot of capable acquirers, and so we have seen a uptick in sellers going to who they believe to be their best partner and saying, hey, it's a little earlier than we thought, but for a lot of reasons we want to transact and we want to do a all stock deal. It's the first time in my career, like I said, I've been doing this since 2008. Everything has always been about headline valuation. And the last year, I've seen much more around exchange ratio and really trying to figure out, if you're selling, go find the best upside. And you're seeing that with M&A deals. I mean, the average M&A deal today is 1.3 times tangible book value. That's 20-30% off of kind of long-term averages. But if you pick the right partner now, you could have better upside ultimately.
Yeah, to your point, it's like the best way to make sure you make your flight is to get to the airport early, right?
Exactly.
Yeah, and I think that's something you're seeing with a lot of deals these days relative to past years. Is M&A is more about solving a problem, and in the past, investors didn't give much credit for rate marks and non-cash items, but you're seeing now companies decide to do M&A. Number one, because I think a lot of banks have waited. They think they're liability sensitive, and I'm a little bit skeptical on some of the modeling out there. But they've been waiting for lower rates, and they continue to grow at 2 to 3% sequentially. M&A is a way for those guys to advance the earnings and bring them out. Where they would have been in 3 years, they can bring into a few quarters out. And banks trade off of earnings, even if in a fixed exchange ratio framework, you're able to clip some upside.
Yeah, the last point I would add, just what we've been seeing too with definitive agreements, you have a lot of acquirers now, whether it's a little less with stock deals, but more on the cash deals. They really want to try to lock in the deal economics and the deal assumptions being used. So you're seeing a lot more negotiations around minimum equity thresholds, caps on transaction expenses, even core deposit closing condition levels. And then from a seller perspective too, because deals are taking longer and longer to get done, and so if they're going to wait around, they want to get kicker payments, maybe special dividends if they have excess capital. So a lot more nuanced on pricing structure than what we've seen. That's been a new trend, I'd say, in the last 2 to 3 years, and what we've typically seen with our M&A deals.
I wanted to maybe ask you about partners, right? Who banks are partnering with. There were a few fintechs that bought some banks, but this really hasn't happened in a long time. Obviously, I think GECO bought a little bank in Minnesota. Radius was acquired by Lending Club, but these were many years ago at this point. And then we can potentially get into credit unions as well. But are there any other partners out there for banks?
Like non-traditional partners.
Non-traditional partners, yeah.
I don't know. Under this regulatory administration, I think it's been really difficult. And actually, almost all the deals that you just talked about, where you had like a non-bank fintech come in, they probably have a consent order now.
Yeah.
The shareholder value probably hasn't played out. A lot of those are still private companies. But I mean, you look at that brokered deposit rule that came out. I'm not an attorney, but I read that and I was like,
that is a killer to fintechs. Right
yeah,
there.
I mean, that is a kill the banking as a service business, and maybe keep it to 10 players or something,
Yeah.
right? There's going to be a couple folks that can do it, but So, and look, this all may be subject to change too if a administration change happens. But no, I mean, I think actually we're going to go back to more regular way, traditional, just bank-to-bank M&A. I do think we're going to see more credit unions. That we've certainly seen an uptick, right? This year's been a record year for that. And so we're going to see more of that. But no, I see less and less of the investor groups coming in. And I also think there's just, because of all the things we're talking about, there just seems to be less enthusiasm from private capital sources. Notwithstanding the folks that were on here earlier, they will always be here. But by and large, there's a lot of money on the sidelines not investing in financial services right now, and that may change. But that's really what's keeping bank stock prices below averages too.
Yeah, on the fintech front, if we advise selling banks, that's generally a no. It's too risky. So I think the most successful investor group deals we see is really driven by or led by a group of former community bankers. Those tend to be the most well-received buyers. And then, on the credit union front, yeah, I mean, they're higher risk transactions, but, these deals, there's a regulatory pathway to get done. I think the big trend that we're seeing now change is, one, the size of the deals are getting much larger than historically, and two, the geographic areas where you're seeing these deals is expanding throughout the country. We're doing a deal right now in New York. You saw 2 branch deals, another one in New York, one in New Jersey. So I mean, it's certainly on the radar screen of banks. So any bank, and if you're a buyer and you're looking at a bank less than $1 billion in assets, you should probably be assuming that you're competing against a credit union.
Well, on the credit union front, I don't mean to shortchange it, Jake, but we've done podcasts where we've had the ex-chairman of the ICBA, and it is very, very controversial to community banks. The credit union.
Well, I would say it's controversial to the associations, not to the lesser extent the community banks.
Thanks for the correction there.
I remember I had a conversation one time where I was told community bankers are against these deals, and I said unless you're the community banker that sold to one.
Yeah,
right?
and that's
because there's a compelling argument to sell to a credit
Absolutely.
union.
Well, and you've seen that. I know, like for example, we're doing a deal down in Louisiana. The Louisiana Bankers Association came out and said, we're not going to oppose or block this. And from what I heard behind the scenes was politically, a lot of the community banks said, we want optionality. Doesn't mean you're going to sell to a credit union, but why limit yourself to a finite number of buyers? Why not bring more to the party, the better?
But Iowa, right?
Iowa's the other way.
They put the kibosh on those deals.
Iowa, Minnesota, Mississippi, Tennessee.
Yeah,
so yeah, certain
state
states,
by state, right?
they get there's a lot of political pressure from the associations for that. But
And it is interesting. We were talking about S4s. I remember an S4 not too long ago where it said specifically in the background that the selling bank went out and actively went to credit unions and marketed themselves because it's all cash. And there's just so many other driving factors to make sense, just strategically, to do your job, to at least put it out there, right?
Absolutely.
Yeah, I think that, my perspective, I think the credit union trend is a little bit overstated. I think, yes, that you are seeing the volume pick up, but relative to the overall number of deals, it's still pretty small. Talking to people that are still on the banking side, you do see them come into processes, but tends to be pretty limited. I think, not an expert in the credit union rules, but I think if you go above 500, you lose a lot of the benefits. $500 million in assets, you lose a lot of the benefits from an M&A perspective of being a credit union, to the extent that you have to report the risk-based capital ratios. So, I do think they're going to become more active, but it's going to be in the sub $500 million area. Really, I think the sub $200 million area in terms of net assets acquired. But make no mistake, there is a lot of benefit. There is a lot of benefit of being a credit union in that when you're bidding on assets in that area. I think it's important as well for banks that are sellers of assets to keep in mind that the deal value that the credit unions are bidding is not apples to apples with the banking deal value, right? Because it's a P&A transaction, and so it's subject to double taxation to the extent you're distributing the proceeds. So it's important to adjust for that as well.
Well, one thing, that's a great point, Jake, just to put this in context. Since the first credit union bank deal, which I think was in 2012, till today, there's been 78 credit union bank deals. Right. There's been over 2,500 bank-to-bank deals. So it's still a small percentage of the overall bank M&A, without question.
That's a good point.
And the geography is a little odd. It's usually
Yeah.
upper Midwestern.
Primarily, it started out primarily Midwest and Southeast Florida. Florida's been a hot market for credit union bank deals. You're seeing it more in the Pacific Northwest. We're doing a deal in the Southwest, New Mexico. But now, generally in the Northeast, Mid-Atlantic, it's not very robust, although we do have a deal in New York, so that may change things. We'll see.
And maybe our last question on the credit union subject, how do you identify a buyer in the credit union space? I mean,
Well,
where do they come from?
Well, depending on what geography you're in, you're usually on the list, scale, size. I mean, a lot of, even these larger deals, the credit union size relative to the bank, the bank's roughly 10 to 25% size ratio to the credit union. So, the reason these deals work is the deal math looks better. Credit unions have the balance sheets to absorb the purchase accounting marks. Obviously, they're looking at earnings on a pre-tax basis, so those deals tend to be more accretive for credit unions. And then from a bank standpoint, really what the fiduciary decision is the price worth the risk? Because it's a longer process partnering up with a credit union than it's doing a bank. Because obviously you're going to have more regulators involved. As Jake noted, it's a P&A structure. And the one thing you have to be really careful with credit union deals is you have to really assess not what the credit union's paying in, is what are you getting out of it? Because the bank's going to have to dissolve, and then they're going to pay out whatever's residual left to shareholders. You have to consider double tax, transaction expenses, impermissible. So they're nuanced transactions. That's why, still, at the end of the day, while you're going to see those deals, they're not going to represent the majority of bank M&A transactions because of the complexities.
Yeah, and when you take when you take all cash consideration, your Revlon duties kick in as well. So from a board perspective, your sole objective is to maximize value, and so that makes that puts an even higher bar on those bids.
Yeah, good point.
Great perspective there. I want to talk a little bit about, it was touched on at the previous panel, but the idea of combining raising capital and announcing a deal. And we've seen a couple of examples. Obviously some of them are the West Banco deal, UMB, Renaissance Connect one with First of Long Island, where it's been some form of capital. We've also seen a couple of instances where the bank has maybe sold their insurance operation and used that to go and do a bank acquisition as well. I was kind of curious what you guys think. Is that something we're going to see more of? And kind of what's the mentality of the buyer when they're making those decisions, and the narrative that they take to the investor side of things?
The insurance company, let's start there, because that one, we've seen a lot of that.
Yeah, Renaissance did it too, I think.
Yeah, we're probably at the tail end of that, only because there's been a lot of insurance sales. The prices, I think that, by the way, it's a great trade. The prices on these insurance deals have been 25, 35 times earnings. It's very rare that the bank stock is going to get valued like that, and so I think it's been in most cases, especially if it's coupled with a regular M&A deal. It's a great use of just capital. You generate capital, you're basically getting over compensated, and then you use that capital for something else. Eastern Bank comes to mind. I think that's a great trade, which, by the way, the market hated that deal. I loved it. I thought it was an awesome deal. Really sharp. But I think we're at the tail end of that. We are starting to see, though, Paul, to your point, more M&A with capital raising, and particularly with common equity. This was prevalent back in the kind of 2016 through 2018 timeframe when you had bank stocks up and trading. The average bank at that time was probably trading at 160, 170 tangible book. It made a lot of sense to finance with common equity. What you're seeing currently is the interest rate mark to market is driving a pretty big capital hole into the combined company, and so the capital is really being raised to fill that. Everybody knows that it's a temporary issue, right? It causes a capital hole at the closing. It comes back over time, but a lot of these interest rate marks come back 5, 6, 7, 8 years. That's a long time, and so you need to raise capital up front. The other piece that's also with it is there's been a much heavier focus around combined company commercial real estate concentration, the whole 300%. Most M&A deals today you're seeing, and put the New York City banks aside because I think it's a very special case, but most companies are announcing deals where the combined company CRE concentration is under 350%. And really everyone's trying to stay under 300. For as long as I've been doing this, that 300 was always a guideline, but if you get into conversations with most agencies today, particularly OCC, that is becoming a very hard and fast rule. And so that is driving a lot of this capital raising. It's not the leverage ratio, it's not CET1, it is CRE concentration.
Yeah, I would just add too, I think that's also a product of the regulatory environment and expectations of the regulators, that you have enough cushion. Again, then that's also a product of deals are just taking longer to get approved. I know you saw that with Lakeland Provident. It took almost 2 years. One of the conditions where Providence had to raise capital, do a sub-debt raise. So I think then from the vantage point of sellers, you want to increase the likelihood you're going to get approved. So they're more receptive to a contingency of a capital raise, or at least doing it as part of signing a definitive agreement, than probably they would be in a different regulatory environment.
I would add, this is a rare time when whether it's hedge funds, mutual funds, are very interested in putting capital to work for M&A deals. That's not usually the case. Usually most institutional investors hate M&A. This is the rare window. So if you want to do a deal, go raise capital now, okay? Because if you've noticed, there's only actually been, I think, 1 or 2 common equity raises in the bank world in the last 24 months that have not been side by side with M&A. The reason for that is if you talk to most of the institutional capital providers, they do not want to put money into a story that's solely a organic growth focus right now. They want a event-driven transaction. And I think part of that also comes back to, I think most people know that the M&A deals being done today, because of some of this interest rate mark to market, these are really accretive transactions. And so there's just a lot of investor interest in it. I mean, you can talk about any of those deals Paul said earlier. A lot of those order books were multiple times oversubscribed.
By the way, that's a frightening proposition for community banks. If they don't have the ability to raise capital for general purposes, and then you look at sub-debt markets where interest rates are at right now, that's always a big question too, is make sure you know what's your source of capital, where you're going to get it. It's one thing if you can do it as part of a large M&A deal, but most institutions don't have that luxury.
Yeah, I mean, the last bank IPO, actually, we worked on it. It was September 2022. Yeah. And so, but there has been, and you're going to see more of them. There are more, I'd say, bolder deals that are going to come with equity capital. There is a acute interest in it, and you have a lot of institutional guys coming off the sidelines, putting money to work there.
Yeah, all great points. Completely agree. I think part of maybe a little bit more pessimistic view of the raises, but I do think the 7 to 8% discount to last does help investors get in the stock. I think M&A more often than not does create value, especially if it's an experienced acquirer. And raising capital at a discount to last trade helps investors get in and kind of offset what the day one impact is going to be, and then participate in the synergy realization over time. Kind of looking at the trends when you last saw this back in 16, 17, which Frank mentioned. I think part of the story there as well was capital volatility. And so, we are in an environment now where forward swap rates move almost on a daily basis, and the story changes month to month. And I think raising capital is another way to kind of shore up against that volatility. Going back to the insurance brokerage trade, I don't think it's limited necessarily to insurance brokerage. I think you're seeing a growth in passive investing, which is making the rotations much more frequent and volatile. And you're seeing, for instance, a lot of trades get levered more to interest rates. And I think you see swings from a valuation perspective with the businesses that are embedded in a bank. So I actually think what set it off was the PNC BlackRock transaction when they got rid of their shares back in 2020 and invested in the banking sector, which was trading at lows back when they did that. So I think you'll see more of those corporate finance value plays as banks try to maximize the sum of the parts.
Yeah, one point on the insurance, we did 2 deals that were not part of like an acquisition. 5-Star in Rochester sold their insurance agent, fairly large deal. I know Evans did that. And that was sort of a byproduct of the capital environment. They were not well positioned to do a capital raise. Obviously, sub-debt was not going to happen. So that was sort of a creative way to raise capital, sort of, without the traditional capital raising methods. That was the driving force for that.
You bring up a good point, and I said earlier there hasn't been a lot of capital raising without M&A. One thing we have seen, I think we're going to see more of it. You'll probably see capital raises coupled with whether it's like NPL sales and/or securities portfolio, like restructuring trades, which kind of is an M&A deal if you think about it. It's you're just buying your own company and doing mark to market on it as opposed to buying somebody else. And so there's going to be more of that too, even with interest rates coming down. Actually, I think now, if you look at it, I think where we ended June 30th on the 5-year Treasury, it's down, I don't know, 50 basis points, 60
But even
basis points.
sub-debt's still going to be too
Sub-debt's-
expensive. They're going to
sub-debt
have
is expensive.
Community banks are going to have to be creative.
Yeah,
with
we're going to see some common equity deals, and I think the capital raising entity is going to be selling out of its securities book. It's still in a loss position, but it's a lot better than it was, and still make the math work ultimately to come out with a better TBV and just EPS, almost like an excuse to raise equity. Like I said, I think institutional investors don't just want to hear organic growth right now. Spreads are still too tight. The environment's not great. But if there's an event-driven catalyst, that is where you get people's interest levels up.
So it's very narrative-driven.
Absolutely.
Yeah.
I'm curious. I know, Frank, earlier you mentioned the Truist deal and kind of sneered at it a little bit, but is there an example of M&A that went well, throughout the whole process, the integration, like everything was, I don't know, exemplary?
Every deal Frank's on.
Give us what is the gold standard?
Well, this would be funny to call this one gold standard, but PacWest and CapSource. If you remember that deal, that was a 2012-13 deal. You matched, at the time, PacWest was a very granular deposit franchise, Southern California, and you basically matched it up with a specialty lending company. And for a long time, the stock outperformed, profitability through the roof, and you could watch it over time. They had some other issues that led to ultimately what has happened in the last 24 months, but that one definitely stands out. And then, just thinking back to the last 2008, cycle, Tolmer Bancorp, which ultimately, through multiple deals, including 2 MOEs that were actually successful, eventually ended up exiting to Huntington. And so basically went from 0 to probably a $50 billion entity, and then ultimately sold and created value all the way up. I think if you looked at the original shareholders and what they ultimately got over about a 15-year period, I think it was a 4 to 5x, and had an opportunity to see that one through a couple of those. And so there are definitely deals that have worked. It's probably a third.
Yeah.
I would say complementary services, and you solve the management team board issues. Increases the likelihood of success from what we've seen.
Yeah, Frank stole my answer. We both worked on the chemical tolmer transaction. I remember that was a no premium. That was actually a discount to where they were trading the day before. And I think someone on the investor call said that the investment bankers should be ashamed of themselves. But I think that deal actually ended up working quite well. I think a little bit biased here, but the Webster Sterling deal, I think they've executed well on that. And that's another one where it's a complementary deal, right? You had the HSA business, the Connecticut branch network. HSA was. I think they were destroying a little bit of value there, but they couldn't fund the business without that. And then you had Sterling contributing their excess liquidity and also, some commercial loan growth to pair with the retail branch network. So,
I'd love to talk about the other side of M&A. We've talked a lot about the things you do before the deal announcement. I'd love to talk about the integration side of things, Jake. I think you'd be great for this. What are the things that are integral to a successful integration?
Yeah, I think it goes way beyond the modeling. So on the banking side, I was mostly focused on the expected financial impact and the modeling. I think a lot of a successful integration is all levered. It is all tied to the people, right? So your ability to mobilize the people, to find to find the cost savings that you modeled in the transaction, right? You're dealing with people's lives, so you don't want to make a mistake, but figuring out where you can extract costs, what sort of systems you want to retain, having a roadmap in advance of announcing the deal on, what the conversion looks like, the path to get there. I think the cost savings usually the initial modeling, you see banks outperform or get pretty close to that number, but where you see M&A deals fail is a failure to plug in the business that you acquire into your organic growth engine. Rarely do you see banks successfully execute on that side, which is fine because usually the transactions aren't dependent on upside from a revenue perspective. But it's thinking about how you can enable your people to grow their businesses, what systems they need access to, whether your policies are supportive of the pro forma entity, how you're going to fund it, where you're going to deploy excess liquidity. So I think going into a transaction with a view on how you're going to enable your people to execute on the modeling that you've done, and also a view on the path to integrating your systems is important.
I'd say with the buyers that I think have done it well, the integration usually really starts during diligence and then really picks up post the announcement. So as soon as all the S4 work, if it's a public deal, is done and the applications are in, they are immediately starting the integration process. So by the time the deal's closed, the playbook is done and it's ready to be executed, and rip the Band-Aid off with a lot of things: systems conversion, cost savings. Where I've seen people struggle is when it takes a longer time period, and then it also gets to the whole culture piece. I think this is, in most cases, it's a people business, and I've seen when you have two different cultures, and this is particularly acute in an MOE deal. If you don't figure that out early on, that's when issues happen, because that's when you lose producers, and that's when then will impact the bottom line ultimately. And that's got to be nipped in the bud if there are issues. And there are always issues. I mean, even in a big bank buys, a smaller bank, does that fit the credit box? And, and so things look different than what maybe you originally modeled.
I would just say, too, I know it's contrary to maximizing cost saves, but I think, and Frank, to your point, you start that integration process. You have to do diligence, and certainly early on in the regulatory process, but it is helpful, particularly if you're going to new markets or there's new lines of business, even if it's an acquisition and it's not an MOE, if you get buy-in from the C-suite of the seller and they're willing to stay, that leads to a smooth integration process, because it will have a trickle-down effect. Because the problem you're going to have naturally until you sign a definitive agreement is the vast majority of the selling organization is not in the know. So how do you onboard those people? How do you incentivize them? Clearly, you're not negotiating any type of retention bonuses or things of that sort till after the fact. But if you have the right C-suite person or groups that stays, that has a good trickle-down effect, and that leads generally to a much smoother integration process from what we've seen.
Yeah, and we just got regulatory approval on our deal last week. So, recently went through the round of questioning from the regulators, and something I found interesting was a lot of questions, not just on the C-suite, but also on the second line. They're very focused on sort of down the employment structure, whether there's execution risk or walkaway risk from personnel leaving. So, especially on the IT side.
The IT and branch network too for that. That's a good point.
And also just interested in talking about the size of sellers. Especially a lot of the deals that we've seen this year with the capital raises have involved folks that are a little bit larger than, and a lot of these have been guys I've seen in that kind of $5 to $8 billion range. So I'm thinking of the First Bank in Mississippi, those kind of guys. Are you guys seeing that that's going to be more of a trend too? If you're going to buy a bank, why not buy a bigger bank rather? Because you're going to have to deal with the same a lot of regulatory questions, costs, all that stuff, risk. Why not just go ahead and buy as big as you can buy? And that also makes things harder for sellers as well.
Well, certainly buyers have to be more selective, because once you find your dance partner, you're with that institution for a long period of time. So you saw, and again, going back to what I said about the policy statements from the FDIC and the OCC, one of the criticisms they'll have is if you're sort of a habitual acquirer, you do multiple deals at once, and they're worried about growth too quickly. So I think for institutions, they're being more selective, and certainly it's more efficient to buy a larger institution than a smaller institution, obviously. So.
Yeah, and that $10 billion asset size threshold, that's a real concern. Folks just do not want to go through it in a organic fashion. So they're either going to buy to go over or sell into it, and that's where you've seen a lot of the activity recently. So absolutely.
But yeah, a lot of guys just choosing to sell rather than do that big deal.
Well, I would say supply and demand too, I think impacts that. If you're a 3, 4, 5 billion institution, depending on your geographic footprint, there's very limited number of banks that you can realistically acquire, or even partner up from an MOE standpoint. So again, what I said earlier, I think the board makes the conclusion, let's just sell and let's partner with a larger bank.
Yeah, I think the other thing that we're saying, and you sort of see this at every size level, and the numbers moved up. It used to be if you were $500 million asset size bank, you could trade actively if you were public. It's not even close to that right now. I mean, I'd make the argument today that to have even a lower level of real market, just liquidity and institutional shareholders, you probably have to be a $3 billion asset size company. I think there's a good argument to say you probably got to be closer to $5 to $6 billion, so you got a market cap in the $500-600 million. And that is, I mean, from our seat, that's driving a lot of M&A. And then it's funny because then when you become $5 billion, you have a lot of those players saying, wait, there's this whole investor universe that won't look at us because we're only at 500 million market cap. We got to get to $1 billion, and that also coincides with the $10 billion asset size threshold. And so it's just the bar keeps moving up. And, I think part of it is too, if you take a step back, just think about this. The best three public bank stocks, if you were to stop the line at, let's say, year-end 2022, or even, let's use 2022. Silicon Valley Bank, Signature Bank, and FRC. And there's we have a chart. I wish I would have brought it with me. I mean, the 10-year TSRs on those three banks at that time are off the charts good. Better than most S&P companies, by the way. So you had a lot of just generalist investors that put money into those entities and who got absolutely smoked. And so you have an environment where generalists have generally stayed away, for lack of a better term, from bank stocks. And look, these things do move and change, but right now a lot of generalist money is invested into NVIDIA or whatever. And so that is causing, though, a market cap problem. It's causing there's less eyeballs and dollars on the space. And for the specialist funds, you've really barely seen any fundraising. And so a lot of those specialist hedge funds tend to invest in the small cap stocks. And so there's not really a bid for those right now because the specialist funds can't raise AUM because of all the issues that all the larger guys have had. So it's still a really, really choppy and tough equity market.
Well, we have a few minutes. Do we want to?
Yeah, if there's any questions from the audience, we have about 7 minutes.
So quickly, just in case anybody over, he just asked, could we see a situation where we see some funds come in and support roll-up strategies, kind of to soak up banks like we have seen in the past?
I think we should, although I think it goes back to it's tough to do the roll-up strategy right now with the regulatory environment. If you only do one deal per year, and maybe it's one deal every 2 years, tough to pull off roll-up. So I think actually, and that's probably why we're seeing capital being raised for more of these transformative deals. It's like, all right, if you're going to have to be on the sidelines anyway for 2 years, go bold. And even, we're starting to, we didn't get into this, but we talked about this. You're starting to see more deals with earn backs in excess of 3 years. Because if you're going to be going out to raise capital and do a deal, go do the deal you want to do, not just pick off a base hit deal. So I think that's what we're going to continue to see. Although, if we do get a administration change, I do think whether banks like Equity, who've done a great job, you're going to see them roll up and go back to doing 2 to 3 deals annually. And yeah, you probably will see more private capital. I mean, absolutely, because there is a good opportunity. Those roll-up vehicles can work well. It's all about management team first and foremost, but there is a model and like a playbook, and so I don't think you've seen it yet, but you should see it if the administration change happens. If not, I don't think you're going to see it.
All right. Well, thank you, Frank, Jeff, Jake, thank you so much. You did not disappoint.